In a nutshell, here are the most important tax benefits for real estate investors. Deductions. This is one of the biggest real estate tax benefits that are available for investors. These tax write-offs, which are often applicable for rental properties, will include costs that have to do with mortgage interest, property tax, operating expenses, depreciation, and repairs. 1031 exchanges. If you are a real estate investor, you can use a tool in the tax code that they call as a 1031 exchange. This tool lets you defer any profits that you make on the sale of your real property if you purchase another similar property of equal or higher value. Capital gains. Investors should pay capital gains tax on the real estate investment property if they don't reinvest the profit they realized on the sale. This also applies if they don't offset it with other losses. Capital gains on a rental property that you sell could go as high as 20% of the profit that you realize, depending on your tax bracket. But as long as you own the property, you don't have to pay capital gains tax. However, when you sell a real estate investment property for a profit, that's the time you have to give the government its share. Depreciation. Another huge tax break that's available to real properties is depreciation. Through this provision, you can recover the cost of an income-producing property via yearly tax deductions. The IRS defines depreciation deduction as an allowance for exhaustion or wear and tear. There are three factors that decide how much an investor can deduct each year in depreciation. They are the value of the property. How much is the property worth? The recovery period for the property. How long is its estimated useful life? The depreciation method they are using to account for it. Are you using the straight line method or another method? Appreciation. When you decide to buy and hold an investment property for a longer period, your net worth could grow with you having to pay taxes on the increase. When you sell any piece of real estate, it exposes you to a lot of expenses, transaction fees, commissions, and taxes. You can avoid paying these expenses and taxes while letting your real estate appreciate. FICA. For passive income investors, your rental income is not subject to Social Security and Medicare taxes, aka FICA. The most popular depreciation method that investors use is the Modified Accelerated Cost Recovery System, MACRS. The IRS allows investors to deduct depreciation expense on a residential property using a factor of 27.5 years and 39 years for commercial real estate. Depreciation allows the owner to recognize a net loss on an investment property due to wear and tear, even if the property is productively generating a positive cash flow. This means that for each year, you can deduct the amount of the value of your improvements, capital expenditures on the property like major property improvements, renovations, such as replacing the roof or finishing the basement. You compute it by dividing the total cost by 27.5 years and then deducting the resulting amount from ordinary taxable income for the year. Here is a simple example. Scenario number 1, without the depreciation expense. For a $10,000 taxable rental income, multiply it by 25%, federal income tax rate, you'll end up owing $2,500 in taxes. Scenario number 2, with depreciation expense. For $10,000 rental income minus a $7,000 depreciation expense, you'll get $3,000 net taxable rental income. Tax computation would be $3,000 times 25% federal income tax rate, or just a $1,200 tax. You can have a savings of $2,500 minus $1,200, $1,300. The higher your tax rate, the more taxes you would save when you take advantage of depreciation expense. Before you jump into the tax saving game, you should separate your long and short-term investments. To know which is which, the short-term investments are those that you've held for 1 year or less. The rest are the long-term investments. For example, you can classify wholesaling, rehabbing, and flipping fall under the short-term investment category, while buy and hold properties normally fall under long-term investments. Ask your CPA to help you properly sort your investments into their correct categories. There is a real estate strategy known as the live and flip that offers you a bountiful tax exemption. If you turn your investment property into a primary residence, you can totally avoid capital gains tax. In order to avail of this provision, you must spend 2 years, or 730 days, living in your home for the last 5 years. The time of occupancy doesn't have to be sequential. Once you have established a sufficient amount of residency, you can sell the home and realize as much as $250,000 in capital gains, or $500,000 if you're married and filing jointly, without having to pay taxes on it. Do you have a good understanding of your partnership or LLC operating agreement? Do you know if your allocations among the members would have substantial economic effect? Also, do you understand what a qualified income offset provision is? What about minimum gain? When it comes to real estate matters, the operating agreements normally address these and other critical tax issues. Most likely, your agreement provides for such issues, so it is important that you are familiar with them inside out. One other way to skip capital gains tax, and also depreciation recapture tax, is by doing a Section 1031 tax-free exchange. This comes from Section 1031 of the U.S. Tax Code. A 1031 exchange enables you to trade one property for another without having to pay taxes. But you should qualify as an investor, not a dealer who flips house or other real estate businessman, and you must follow the government's specific guidelines. Important. Note that you can only exchange real property, real estate building, and land. Why go to this route? Well, you can use 100% of the profits from the sale to reinvest in another property. You then take advantage of the growth and compounding of your investments to the full. For example, let's say you sell a property for $250,000 and don't avail of a 1031 exchange. You might end up paying $30,000 in capital gain and depreciation recapture taxes. If you avail of a 1031 exchange, the $30,000 would remain invested in your assets. Assuming that you're getting a 3% return for it, in the next 15 years, your $30,000 would grow to more than $47,000. That's it for now. On our website, you can find more posts, as well as calculators and other financial tools. Which of the strategies work better for you? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos for free.